Now we're going to look at the balance sheet. This is fairly complex, and not everybody's going to need a balance sheet if you're doing a basic startup business plan. But the purpose of this was to make this for even the businesses who are a little more sophisticated or who are working with an accountant to provide this. The data that's pulled across is going to be here. First is your as of date. So this was 3/1/22. So this is the start of the plan. Sorry, 3/12/22. It's cash, total current assets, which was the cash. So you could add other items. If you add anything in here, for example, if you had $1,000 inventory, you could see how that changes it, your current assets, because inventory is a current asset. And you can then bring this in years 1, 2, and 3. The reason it's not carried across is this is a financial planning tool. It does not pull in accounts receivable. It does not pull in inventory, prepaid expenses, and other current assets. You can put these in to build out your current or short-term assets. The same is true for your fixed or long-term assets. You can enter any dollar amount you want. If you have $20,000 in long-term assets, there you go. Sorry, $200,000 in this case. Woo, that's a lot of assets. So, again, for each year, the data you see in the shaded is carried across for lease equipment, capital equipment. So it provides the value of that if it's a capital lease. We have then the summary of total fixed assets, so you can add anything else you want. Other assets, left it blank, you can add anything in. You can see on the right how to fill out your balance sheet. So if you go through this, it'll tell you kind of what we're looking for in these fields. Now let's get to liabilities and owner's equity. First is your short-term liabilities. Short-term liabilities are liabilities that are due within the next 12 months. So we can forecast short-term loans and liabilities. Clearly, we left this blank because there's nothing we're putting in here under this is forecast. You're not forecasting for the current date, so it's blank. Anything existing you have, you can put in here. If you got $2,000 coming due this year, you put $2,000 in this cell. But in here, these ones that are gray, these are calculated. So any loans that you forecast in the financing tab, any portion that becomes due during year 1, 2, or 3 get reflected in here automatically. You can also put in any income taxes payable, accrued salaries. This is all standard balance sheet information. Working with your accountant, you can do this without any problem. Unearned revenue and such. So then you get the current portion of long-term debt. So this is debt that's due within the upcoming 12 months. So it'll be 12 months for year 1, then what's going to be coming due 12 months in year 2 and 12 months in year 3. So then you get your total current liabilities. Now let's look at long-term liabilities. So long-term is what's outstanding other than the part that's due in the next 12 months. It's longer term. So remainder of any prior long-term debt, you can add that manually. It's before the financial plan. And as you can see here, each year for remainder of forecast long-term debt, when you're doing stuff within the financing tab, all the information that you have here on new conventional loans and merchant cash advance, business line of credit, well, that is going to become part of your long-term debt. So anything that's not due in the short term will get calculated and inserted as the remainder. So it's all taken care of automatically for you. Add in deferred income tax or other, and you get your total long-term. Owner's equity is really going to be, as you can see, how to calculate owner's equity. You can put in any owner investment that you have. Then you have your retained earnings that came across. If you notice on the on the other tab, we looked at profit and loss. We said adjustment to retained earnings is minus $62,000. Yeah, there it is. So it came across. So anything from that automatically comes here, and you get that. We also provide some financial ratios. These are used by some lenders and investors to look at the ratios for you compared to the rest of your industry. Debt ratio, current ratio, which is your current assets to current liabilities. That's a measure of your liquidity. The working capital, current assets minus current liabilities. That's what you have available as working capital. And if you need more to cover seasonal issues or for inventory, that's where you may need a either cash advance or a working capital loan. Then assets to equity ratio, it's all explained over here. And then debt to equity ratio, so loan total liabilities by owner's equity. Again, standard financial industry ratios that lenders often use when evaluating an out loan application. So as you can see, what you have on this tab in this workbook is a lot more than you get from most other tools that will help you for doing financial analysis. That's the end of our balance sheet video.